Yesterday and today, financial markets have been riveted to the two-day semi-annual testimony of Jerome Powell in front of the Senate Banking Committee on Capitol Hill. If the Fed chairman sticks to the hawkish rhetoric and signals further aggressive tightening, it means faster rate hikes. In turn, the US dollar will receive solid support. Conversely, if the policymaker voices concern over economic conditions and the recession threat, investors will be discouraged for sure, so the US dollar will lose its footing across the boat. Nevertheless, there are some factors that could assure market participants to revise sentiment. The economic calendar reminds us about a series of macroeconomic data that will be of greater importance to the market sentiment than the keynote speech by the Fed's leader. So let's discuss everything in our regular calendar on the InstaForex TV channel. During the Asia-Pacific session tomorrow, the market will get to know the inflation dynamic in China. Unlike advanced economies, consumer inflation in China has been accelerating at a moderate pace. Moreover, the annual CPI even misses the target level set by the government at 3%. Importantly, earlier this week, Beijing unveiled its forecast of economic growth for 2023. GDP is expected to expand by only 5%. Investors considered this a sign of a weakness and lost the appetite for risk. A decline in inflation rates is a precursor of an economic slowdown, so if the forecast of the CPI at 1.9% comes true, traders will rush to sell risky assets. On Thursday, Japan is due to report on its economic growth for the first quarter. However, traders speculating on the dollar-yen pair will give priority to the news of the next day. On Friday, the Bank of Japan will announce the policy decision taken at the last meeting. That will be chaired by outgoing Governor Haruhiko Kuroda. Taking into account the mindset of Japan, cardinal changes will hardly be introduced. Previously, the newly appointed head of Japan's central bank stated his intention to pursue the ongoing course of monetary policy. Thus, investors will continue to price in the difference in interest rates, which benefits the US dollar. Japan's regulator maintains the key interest rate at historic lows with the aim of propping up economic growth. In contrast, Western countries, which are focused on the struggle against soaring inflation by increasing interest rates, have already encountered a dismal fallout. The British economy has already locked an economic contraction from a month ago. The Bank of England has acknowledged a recession, which is likely to be profound and persistent. Besides, industrial production in the United Kingdom shrank by 4% in annual terms. On Friday, market participants will have to digest economic reports that will hardly inspire optimism. Should the UK economy reveal any growth, it will be just a 0.1% uptick in January. Industrial production is expected to stagnate. Under such economic conditions, the pound sterling will not be able to recoup losses against the US dollar. Thus, the pound-dollar pair is set to go down. The Canadian dollar also will not be able to assert its strength. Judging by the consensus, investors will be disappointed by the report on Canada's labor market, which is due on Friday. The unemployment rate could have grown, and employment growth could have eased dramatically to 6,000, the lowest reading since August 2022. And the labor market is obviously cooling down. That's sending the Bank of Canada the message: the time is ripe to take a breath in raising interest rates. The situation in the United States is exactly the opposite. The labor market is overheated. The normal pace of employment growth is recognized as a 200,000 jobs per month. Nowadays, the average employment growth in the United States stands up at 401,000 per month. That is twice higher. Despite announcements of massive job cuts in top American companies, the statistics reveal a totally different trend which escalates inflationary risks and forces the Federal Reserve to go ahead with aggressive monetary tightening and sharp rate hikes. If the NONFARM payrolls for February again confirm that the labor market is at 2/10, the U.S. Central Bank will evidently maintain its hawkish rhetoric and will venture into a rate hike by 50 basis points. And this scenario is certainly bullish for the US dollar. And we will monitor the market reaction to the above-mentioned reports. Subscribe to our channel and follow changes in the market sentiment with us. Any comments, questions and offers are welcomed. We wish you profitable trading and see you soon.